Welcome to The Explainer. Today, we're unpacking the fascinating fiscal 2026 financial results of Crown Crafts. Now, if you follow the consumer goods sector, you already know the infant and toddler space is just an incredibly complex web. We're talking shifting demographics, global supply chains, fierce retail competition, the whole shebang. So we're going to peel back the layers of this particular onion to see exactly how a legacy company adapts when the ground beneath them is constantly shifting. To do this, we're diving right into their official SEC Form 10-K and recent earnings release. We brewed a massively large pot of coffee and waded through all that dense legalese, so, well, you don't have to. By looking closely at the data they're legally required to report, we get a true behind-the-scenes look at the infant consumer products industry. We aren't looking at corporate spin here. We're looking at the raw, unfiltered numbers and those strategic disclosures management absolutely has to make to their investors. Okay, let's dive into this massive mystery staring us right in the face. Because on paper, Crown Crafts was facing an absolute perfect storm in fiscal 2026. Sales are down. The U.S. birth rate is shrinking. Tariffs on Chinese imports have caused total supply chain chaos. And yet, somehow, they've pulled off this remarkable magic trick with their profit margins. How exactly do you make more out of less in a shrinking market? Here's our roadmap to figure that out. We'll start with Section 1, the FY26 financial checkup. Then we'll look at 2, the Crown Crafts playbook, before hitting 3, the supply chain squeeze. After that, we'll outline 4, navigating industry headwinds, and finally wrap up with 5, looking ahead. Let's peel back the very first layer of our onion with Section 1, our FY26 financial checkup, focusing on those Q4 and full-year results. Now, the contrast here is just incredible. The top line reveals that fourth quarter sales actually dropped, going down from $23.2 million to $22.4 million. Usually, you'd expect a drop in sales to absolutely hammer the bottom line, right? But they managed to turn a massive $10.8 million net loss last year into a $300,000 profit this year. Now, it's important context that last year's massive loss did include a heavy one-time goodwill impairment charge. That's basically an accounting adjustment writing down the value of past acquisitions. But even when you factor that out entirely, their fundamental profitability completely shifted gears. As CEO Olivia Elliott perfectly explains, they boosted their gross profit margin up by an impressive 460 basis points. That is 4.6 percentage points, taking it from 18.3% up to 22.9%. They pulled this off by focusing obsessively on pricing and product mix rather than just chasing pure volume. They realized that in a tough environment, going after every single sale just isn't as valuable as making sure the sales you do make are actually profitable. Ongoing spending discipline and pushing higher margin items literally changed the math of their entire business. To really understand how they actually pull that off and where their vulnerabilities might lie, we need to move to Section 2, the Crown Crafts playbook, featuring a business model breakdown. The absolute most crucial point of this playbook is their extreme customer concentration. A staggering 57% of their entire sales volume relies completely on just 2 retail giants. We're talking Walmart at 40% and Amazon at 17%. It's a massive double-edged sword. On one hand, having the 2 biggest retailers in the world as your main buyers gives you incredible scale and reach. But on the other hand, it gives those retailers massive leverage over pricing. If either of them suddenly changed their inventory strategies or, say, dropped a Crown Crafts product line altogether, the impact on revenue would be immediate and severe. And there's also a heavy dependency when it comes to intellectual property. A full 52% of their gross sales come from licensed products, and specifically, whopping 23% of their total gross sales are tied directly to just one licensor, Disney. This makes their corporate partnerships incredibly high stakes. Their current agreement with Disney runs through December 2027, so if a movie underperforms or a character loses popularity, or if that contract simply isn't renewed, nearly a quarter of their business is on the line. For us watching this sector, it's just a stark reminder of how tightly consumer brands are tied to Hollywood's success. But hey, making the products is just as complex as selling them. Let's move to Section 3, the supply chain squeeze, looking at global manufacturing. See, Crown Crafts relies heavily on foreign contract manufacturers, primarily in China, which means they've been subjected to absolute whiplash regarding tariffs. In 2025, the U.S. imposed heavy new tariffs on Chinese imports, abruptly driving up costs that Crown Crafts freely admitted they couldn't fully pass on to consumers. But then, we get a massive legal shift. In February 2026, the U.S. Supreme Court ruled that tariffs imposed under the International Emergency Economic Powers Act, or IEEPA, were actually illegal.
Fast forward to April 2026, and a new government platform called CAPE is launched for companies to request refunds on those exact tariffs. Crown Crafts has already submitted their eligible entries. It's such a vivid picture of how international trade policies directly hit a company's bottom line. They literally had to pivot from absorbing surprise costs one year to fighting for millions in legal refunds the next.
But tariffs are really just one part of the problem. This brings us to Section 4, navigating industry headwinds and the broader macroeconomic threats they face. If you look at the risk factors outlined in their 10K, they face immense vulnerabilities. Let's start with the most existential one, declining U.S. birth rates. For a company that literally sells bibs, crib bedding, and baby toys, fewer babies directly equals a shrinking total addressable market. There's just no way around it. Add to that inflation driving up the cost of raw materials like cotton and oil. Then you throw in global geopolitical conflicts, tensions in the Middle East, the Russia-Ukraine war, instability around Taiwan, all of which threaten the shipping lanes and international factories they rely on. They even explicitly note climate change, pointing out that extreme weather, rising sea levels, and inland flooding pose very real physical risks to their logistics and warehouse facilities. So, faced with a shrinking customer base, highly concentrated retail partners, and wildly volatile supply chains, we reach Section 5, looking ahead and their ultimate survival strategy. One major strategy we see them deploying is a renewed focus on internal product development to reduce that heavy reliance on outside licensors like Disney. A really prime example of this is their May 2026 relaunch of the Groovy Girls doll line under their Manhattan toy brand. By reviving an iconic, old brand, they control the intellectual property, they capture the full profit margin, and they don't have to pay out any minimum guaranteed royalties to outside partners. It's a really smart, direct play to spark new consumer demand while protecting those newly expanded profit margins.
Furthermore, the company is signaling deep, deep confidence in their financial health. Despite all those massive macroeconomic threats we just talked about, they still generated over $8 million in operating cash flow over the fiscal year. Because of that, they're returning capital to shareholders, declaring a quarterly cash dividend of 8 cents per share. It's basically management's way of saying, yes, the waters are incredibly choppy right now, but our ship is sturdy enough to pay you while we navigate.
Which leaves us with this final, truly provocative thought. Crown Crafts has proven they can play defense masterfully. They found margin magic by focusing on profitable products and disciplined spending, even as their overall sales dipped. But in an environment of permanently falling birth rates and relentless global instability, is playing defense enough? Can margin expansion and internal brand relaunches secure their long-term future? Or will the sheer weight of macroeconomic gravity eventually pull them down? It's a fascinating case study in corporate resilience, and definitely one we're going to keep our eyes on. Thanks so much for joining me for this explainer, and I'll catch you on the next one.